but it was 50 years ago when Nixon took us off the gold standard. And it's not ironic that before we went off the gold standard, we didn't have huge deficits and we never had a budget deficit because we had to stay within our financial means. And some people argue, well, let's bring back a gold standard. Well, I don't know what the price of gold would have to be to cover the amount of debt that's out there. I don't know if a gold standard is going to be the answer eventually to this debt problem. I think part of it is going to be inflationary and part of it's going to be reneging on it. And it doesn't bode well if you look past the next few months, a couple of years. Anybody, someone like your age and all that still has young family and all, I think they're going to face far more challenging times than any other generation in America.
Think. Act. And prosper. You are now tuned into the Money Level Show.
Hey everyone, welcome to the Money Level Show. I'm your host, Daryl Thomas, and here we think, act, and prosper. This channel focuses on changing financial trajectories and building legacies. Today, we have the opportunity of speaking with Peter Grandich of petergrandich.com. Peter is a financial advisor. He specifically worked with professional athletes in the NFL and many other sports. He also has an extensive history on Wall Street since the 1980s and has worked with multiple hedge funds. Today, we get Peter's thoughts on Americans being in over $1 trillion in debt, where the gold markets are headed, natural resources, and globalization. So as we jump into the interview, I do want to share that in the link in the description below, there's a affiliate link to the New Orleans Investment Conference, which I will share more about. But this conference is put on by Brian Lundeen, and this year they're going to have speakers such as Rick Rule, Lynn Alden, Danielle DiMartino Booth, Jim Rickards, Peter Schiff, George Gammon, and many others. So be sure to click the link in the description below so that you can join that conference. So without further ado, let's go ahead and get to the interview. Hey, Peter, how's it going? Glad to have you back.
Glad to be back and glad to be back on the other side of the microphone.
Yeah. For those who haven't watched it, Peter did a interview with me on his channel, which I'll be sure to link in the description below. So be sure to check that out. It was kind of interesting being on the other side of the
Yes, it is.
of the equation.
I think you're more comfortable there and I'm more comfortable here. So let's go.
Yes, indeed. Yes, indeed. So we had a few things happen recently. We've hit a record for credit card debt with Americans. I believe it's over $1 trillion. We've had a lot of news coming out about Americans tapping into their retirement early to combat the economic environment that we're in. Obviously, the CPI says that inflation is at 3%, but it seems like people are experiencing more harder inflation than that. What's your take on all of this?
So, Daryl, as you know, as a fellow believer, the best financial book ever written is called the Holy Bible. And there's more about matters of finance and things than there is about heaven and hell. So whoever the author was, if you're not a believer and just want to look at it as an historic book, that's okay. But let's know that book has had more influence than any other book and all the financial books combined written. And when you think about it, there's not one positive verse about debt. In fact, there's a lot of negative verses about debt and the troubles that debt leads to. And you can understand that now when you look at a country that it's still hard for me, Daryl, to grasp, because when I started in the business in 1984, or some young guys like to say, when you were a dinosaur, we were the world's largest creditor nation. It was unfathomable to think of debts in trillions. Now we have deficits in trillions. And here's the real kicker that people are going to have to grab onto soon, Daryl, or so many more people are going to be hurt than necessary. The CBO, the Congressional Budget Office, it's really a bipartisan organization, if the closest thing to a bipartisan organization. And they have spoke earlier this year and continue to harp on that in less than 10 years, their prediction is going to be that we're going to be at $50 trillion in debt, hard debt. And by the way, that doesn't include paying daily for Social Security, Medicare, or Medicaid, which people estimate is anywhere from 50 to another 100 trillion. What I like to ask all the people that are extremely bullish about the future and future past the next 6 months or a couple of years is how do we service the interest on that? When we only took in our best year ever last year about 5 trillion in revenue at 50 trillion and 5% interest rate, which is not a big rate, we're seeing that now. That's $2.5 trillion in interest expense. And remember now, we borrow money just to pay the interest we owe, not any principal, just the interest. And so when you take that and you take into the numbers that you talked about, consumer debt, corporate debt, it's unfathomable how anybody can say to me that there's no reason to be concerned about that four-letter word that the author or authors of the best book ever written said to be very careful and be concerned about.
Mm-hmm. Hang on real quick. I'm going to shut this window. Getting a lot of cars and stuff. All right, there we go. Yeah, so debt is definitely gripping a lot of people. The Bible says the borrower is slave to the lender. And so, looking at this, how are you factoring in recession possibilities or whatnot? I know that recently China cut rates over there, and that had a big drawdown on the market. And sometimes that is like foretelling of what we could experience here. So what's your take on like how this pressure, it seems like there's a lot of pressure on people, on the banking system and things like that. And it sounds like, the government, the mainstream financial news, the Fed are trying to minimize that. Hello, everyone. Sorry for the break in action, but I want to tell you about the link in my description below. This is to the New Orleans Investment Conference. This conference has been around for years and have brought many people out, such as Milton Friedman, Gerald Ford, Alan Greenspan, and Margaret Thatcher. This conference is put on by Brian Lundeen and his team. Brian is the CEO of Gold Newsletter. This year, they're going to have speakers such as Jim Rickards, George Gammon, Peter Schiff, Rick Rule, Danielle DiMartino Booth, Lynn Alden, and many others. Now, I encourage you to click the link in the description below. You can choose to attend the live event, which I will likely be at, as well as the event that is live streamed. You can support the channel by using my link below, so I encourage you to check that out. Now, let's get back to the interview.
As you know, and I want to respond to the China thing as well, but as you know, it's been my belief now for well over 2, maybe as much as 3 years, that America had entered its worst ever social, political, and economic era in its history. And when you think of some of the terrible things that happened in that history, to know that we've rivaled that or surpassed that is not a good thing. One of the ways I know that is, well, you can just turn on the TV to find that out if you want to watch regular news. But the bottom line is, we have 2/3 of Americans working paycheck to paycheck now. There's no room for error. And inflation is still higher than what they're getting in wage increases. So the majority of Americans and the vast majority of Americans are slipping. It's actually costing them more to do the same things that used to cost them 5 or 10 years ago. And so while the elitists and the high income earners, maybe in the top 10 or 15%, aren't impacted by that, the vast majority of Americans are. And they are getting to the point where they're borrowing just to buy necessities. And if you talk to anybody in any section of the country that runs a food bank, they will tell you not only is the number of people showing up dramatically increasing, but the levels of income earners are increasing because it's coming that much more difficult. So when we hear what I like to coin the "don't worry, be happy" crowd paint a nirvana situation of the future, when we can't going to be able to service our debt soon, let alone any idea of paying it off, We have political issues now, and I'm not here, Daryl, and I really don't. I don't get into who's right or wrong. All I know is this. If you and I were having a conversation 10 or 20 years ago, and I was talking about some country where the guy that used to be president, who was trying to run again, has been charged in, I don't know how many counts now, 80, 90 charges. And the guy that's currently president, him and his family are under real suspicion of all sorts of things that are wrong and all. We would have said, hey, that must be one of those banana republics in South America. Well, now those banana republics is here in the United States. And so on every issue, political, social, and economics, I see nothing but dark times. And I must tell you, Darryl, when you're in a planning business, that's really what's left of my lively income other than what I make for my own investments. And you're painting pictures like this. Trust me, most people go down to the guy down the street. They don't want to hear things like this. They don't want to hear things about less is more. They don't want to hear things about cutting back and all that type of stuff. But truthfully, Daryl, in a few years' times, we're going to be facing an enormous economic crunch just because of what we owe. And the one thing you need to get hold of and yell at, whether they're Democrat, Republican, or independent, when some politician stands up and says, I'm going to lower taxes. We can't lower taxes. We can only raise taxes, and that's why we continue to do so, because our deficits keep getting bigger and bigger. So I like to paint a better picture. It would probably be easier for business and easier for me to get through a day and not have to keep rehashing all of this and seeing this. But I also believe everything that's happened in my life, Darrell, was to be this voice right now, even though there aren't many with that voice.
Yeah, that's very interesting and true. So there's this dynamic of quantitative easing by the Fed, as well as the wealth gap continuously increasing. I mean, we've had articles come out in recent years about Americans not being able to cover a $500 to a $1,000 emergency expense. And so I'm just going to share my screen here. These are the total assets held by the top 1%. And this over here is in millions of dollars. I'm trying to interpret this number in my mind over here. But as you can see, just since the 90s, how this has increased dramatically for the top 1%. And I imagine the 99% is probably on the decline.
It would be the opposite of that, obviously.
Yeah.
If they making more, somebody had to be making less.
Yeah, exactly. And so, and I was looking at, some of these dips as well. And also like the some of this was due to like offshoring of our businesses and our jobs. I mean, we saw the wealth gap increase a whole lot since I think it was when China was brought into the was it Global World Trade Organization or something, and many of those jobs went overseas, and we saw the wealth gap continue to increase. But I mean, here it just seems like there's no end in sight, and I'm not sure what the Fed or our fiscal policy or our government is doing to even address this.
So the Federal Reserve is not for the little guy. I mean, they're an extension. Remember, they're really a private organization, even though there's a lot of intertwining with the federal government. But I think the amount of discrepancy now between the average American and the so-called well-off is the widest it's ever been, and that's why also there's been a tilt to socialist or socialist type ideas by a fringe part of so-called the Democratic Party, because it has an audience that wants to hear that. When you can point and say, listen, you're killing yourself, you're making less, and look at those people living over there, they're getting the high and mighty, it's off of your back. And you can understand why some people want to listen to that, and then say, well, listen, we need to take from them and distribute it to you. And I think that will continue to be an argument that fringe group will have, and it will actually grow louder as things become tougher and tougher. But I think what people always say, well, what can I do in this? And of course, I have always two simple answers, but it's very hard for Americans to do, and that is to accept something that I chose to almost 20 years ago, and that was an attitude of less is more. That if I lessened my overhead, my style of living, I will actually have a more fruitful life. And that is not something that I lived in the first 20 years of my career. It was the opposite. More money was going to equal more happiness and things of that nature. And then also recognize that more and more of what we earn, for those that remain pulling the wagon versus being in the wagon and getting pulled, the more the government's going to look to take from us. And so we have to find as many legal means as we can to lessen our burden. That's why there's been such a dramatic demographic shift on where higher income earners are living now. The difference of living in New York City, where you pay a very high federal, state, and city tax, and moving to a state of Florida, where you only would then still have the federal tax, has meant huge differences in income to certain people, and also helped make Florida, in a sense, become more expensive because so many people are moving there. But the inequality is a true argument about pay. You know, when you see CEOs making 3,000 times more than an average worker, there's just something not. I mean, I understand where they're at and all, but are they that much more important than the person, doing the menial work and all? And that's where the discrepancy is growing. And Daryl, it's interesting. Just the other day, because no one talks about it anymore, because younger people don't remember it. But it was 50 years ago when Nixon took us off the gold standard. And it's not ironic that before we went off the gold standard, we didn't have huge deficits and we never had a budget deficit because we had to stay within our financial means. And some people argue, well, let's bring back a gold standard. Well, I don't know what the price of gold would have to be to cover the amount of debt that's out there. I don't know if a gold standard is going to be the answer eventually to this debt problem. I think part of it is going to be inflationary, and part of it's going to be reneging on it. And it doesn't bode well if you look past the next few months or couple of years. Anybody, someone like your age and all, that still has young family and all, I think they're going to face far more challenging times than any other generation in America.
Yeah, shout out to the millennial generation.
Well, you can
So,
understand, but you can understand why they're starting to voice themselves
yeah,
because people are smart and realizing that. And they're saying, hey, listen, and that's going to lead to, you and I discussed this before, and it's something worthy to think about. It's going to become a battle of the ages. It's going to get a point to where somebody 30, 35 who's being taxed unbelievably percentage more than I might have been when I was 30, 35, saying, why are we paying 500,000 for some special operation for a 92-year-old person? And then the 92-year-old person is going to say, well, I want to live and you took all the money from me and now I expect to be taken care of. There's going to be a battle of the ages when all this really becomes to an extreme. And it's going to be sad because it's going to pit family members. I mean, we see this in areas of the world already. Japan is going to get to a point not too distant in the future where they're going to have one person working for every person that's retired. That's unsustainable.
yeah,
It can't continue in that way.
yeah, definitely. And you said like something very. This has been confirmed, in my mind multiple times, and it's biblical. A lot of people may not know this, but it's biblical when you say less is more. So I was recently at the Rule Symposium, and I had lunch with a CEO of a uranium company, and I asked him the question of like, oh, how did you begin to build your wealth? And he said that like he would have his base income and he would try to live two levels below that, so that he could actually build wealth. And this is biblical because like in Proverbs 13:7, it says that one person pretends to be rich, yet has nothing. Another person pretends to be poor, yet has great wealth.
Well, it's an amazing, and I think that's why you and I have this rapport. I, in my work, have stated 7 out of 10 people that come in, from everyday workers to the athletes that I used to deal with that were making tens of millions of dollars a year, they all live at least one lifestyle, sometimes two lifestyles above where their income is. And everybody goes, well, how can they do that? Well, they do it two ways. They borrow and they don't put away for the future. They don't save for retirement. They use money that should be saved for kids and other stuff to live a lifestyle now. And that really comes from a long, long co-conspiracy between Wall Street and Madison Avenue that more money equals more happiness. You can basically turn on any financial service commercial, and basically the argument behind their commercial is come with us, we'll achieve all your goals, and then they'll show you how you live happily ever after. And we found things that somehow more products would make us happy, bigger homes would make us happy. And yet, despite now families living in much larger dwellings, have much more stuff than their parents or grandparents have, we still need public storage facilities to store some of that extra stuff in. And it's an old George Carlin line, but the problem is we have too much stuff.
Yeah, agreed. Way too much stuff. So just looking at all these dynamics, so you've worked with professional athletes, and I mean there's always stories about them living, blowing a lot of money and such. We've had, I mean, many people that have blown massive amounts of wealth. And part of this is also like one thing that I'm noticing is the advisor role. I mean, obviously, not everyone is a good advisor, and then you've had many of them have had close friends and people. I'm watching the movie. I don't know if you've seen the movie about George Foreman. But his comeback to becoming a pastor, and then his friend who was his accountant, gambled off a lot of the money and stole money. So like, that's like a dynamic too. And so like, whenever I'm talking with people around me, many of them, do have the meetings with their financial advisors and stuff. And, and I kind of like, pick around to see like, okay, what do they have you invested in? Is it like, is it the cookie cutter approach, or, how much are you paying for this and things like that? What's kind of your advice to someone who's trying to pick a financial advisor to help them navigate this turbulent times?
Well, first, let me respond, I think, because you'll enjoy this. A couple quick stories about athletes and money. I worked 13 years with the New York Giants doing Bible study, chapel, and working with players and coaches. And of course, because of that, some of them became clients of mine. And I'll never forget, I can't remember who it was, and if it was, I couldn't say the name anyway, but someone signed a very big contract and got some very big upfront money. Now, guaranteed money has become the norm in the NFL. But 10 or 15 years ago, it was the one major sport where there wasn't guaranteed money. Your contract wasn't guaranteed completely. Where in basketball, baseball, you sign for 55 million, they got to pay you unless you do something that violates the contract law. Anyway, some big player came in and he got a lot of money, so he went and bought, a $4 or $5 million home. A younger kid, that same age as him, maybe undrafted or maybe a sixth or seventh round draft choice. I mean, he got a nice chunk of change for someone that age, but it wasn't the type of money he could retire on at all. In order to be like that guy, he went and rented a home in that same neighborhood and paid an astronomical money. The guy that got the big contract, he went and bought a $150,000 car. The other kid to look like him and hang with him, he went and leased a car like that. The guy was wearing 20,000 in jewelry around his neck. Either it was 20,000 in real or really good jewelry. And it was something just seen so much. And my partner, Lee Roussan, who was a running back on the first two Giants Super Bowl teams, used to tell him, listen, the NFL back then stands for not for long. 80% of players won't even make enough years to qualify for a pension. You're one industry away from going down. And of course, that's been one of the shocks. And then the other thing that would happen that didn't get spoken about a lot is family members. Suddenly, your second and third cousins are showing up with all sorts of investment ideas after you signed the big contract and all. Financial advisory is I think you have to treat it the same way you would do a doctor or a lawyer. Now, here's a statistic that a lot of people in the business don't like quote it. But according to Nobel laureate studies, multiple Nobel laureates who weren't paid by a financial service firm but went out and did it as independent, they found that 8 out of 10 equity money managers underperform an index fund, and 85% of bond fund managers underperform an index fund, which meant that for most people, 8 out of 10 times, you would have been better off putting it in an index fund than you would have gone with a particular advisor. I don't know anybody that would be facing either a legal battle or a medical issue that would want a doctor or a lawyer that underperformed 8 out of 10 times and chance that this is the 2 times that they're going to do right. And that's unfortunately why more people than not, despite a tremendous all-time bull market that went on for decades, both in bonds and stocks, the average person still didn't reach the nirvana that the ads add up to. And that's because more financial advisors underperformed than overperformed. One of the things I think I always tell people is this. Normally, you're going to know somebody that's been successful, or if you don't know them, you have a chance to speak to them. Many times they're willing to share their secrets, but one of the things you're going to find out, and a lot of financial people don't like this told, Daryl, here's how most people make money. One, they inherited it. They weren't the ones that made it. It was just passed on to them. Second, they had small to mid-sized businesses. They made it on their own brow. Third, they invested, which I think now is a change. It's not going to be the same, but back then, in commercial real estate. I don't mean flipping houses, but going out and investing in commercial real estate, buying homes that would bring in income, office buildings, or they worked for a major company that was public, and they got a lot of stock options, which were always given to them lower than the stock price, and over the years they made money in that. I don't think in 40 years I can count on one hand where I've heard the story, oh, mom and dad put a few thousand in the market each year, walked away with 2 million. It just doesn't go that way. I think more people who work in the business make money than people that deal with them. So I think it's a lot more challenging. For instance, I've had the worst year or almost year and a half that I've ever had in my life in an area where I was supposed to be considered an expert, metals and mining. I'm down levels that I never even imagined I would even have when I was a younger person. And I'm supposed to be an expert in that area and an honest person. I think I'm still the honest person, but after this performance, I don't know if I'm the expert that I might have thought I once was. And so it's very, very difficult to get prudent, honest financial advice. And I think most times your gut, your intuition, and if you're a believer, hopefully the Holy Spirit will lead you or tell you that what you're hearing or what you're hearing is good or not so good. What really concerns me, Daryl, is when people go to a conference, never met the person before that conference, and by the end of the conference, they're writing checks out for oil partnerships or whatever it may be and all. And a lot of times they do it because they're under this belief the boat's going to sail without them. One thing I can tell you, after 40 years, there's no boats, there's ferries. If one sails, another one will come back in.
Hey, everyone. Sorry for the break in action. We are going to continue this interview in part 2 tomorrow. Be sure to hit the subscribe button and the like button so that this video gets out into the algorithms and so that you can be notified when part 2 is uploaded from this interview with Peter Grandich. I want to thank you all for supporting the channel and watching this today. And you all have a good day and see you tomorrow.